All is not well in the world's second largest economy.
Fears are rising about China's economic slowdown.
China's having money problems too. Its provinces and local governments are out of cash. They need some debt relief and they need it fast.
And there's no good news for the Chinese economy. Well, the World Bank has said that China's recovery remains fragile.
Historically, China was one of the world's biggest economic powers until the 19th century. After the 1978 economic reforms, China registered double-digit GDP growth rates for 3 decades, ranging from 10 to 13% annually. China's return to being one of the largest economies in the world was the quickest for any country in history. It is the largest trading nation in the world with the largest manufacturing economy. It has the world's largest foreign exchange reserves, worth $3.2 trillion. After the 2008 global financial crisis, China doubled down on its investment-driven growth model. Beijing instructed banks to offer loans under industrial, infrastructure and real estate schemes at a scale larger than that could be justified. China's economic growth is slowing down this decade due to a range of issues: government policies, an aging population, weak consumer demand, unemployment, and a real estate crisis. While China received $163 billion worth of FDI in 2020, making it the largest recipient in the world, in 2023 the country received only $33 billion on a net basis, down 80% from 22. This is a 30-year low. This year, China has announced a growth target of around 5%, which sounds ambitious at this point. The IMF has projected China's growth at 4.6% in 2024, declining towards 3.5% by 2028. So what really happened? The property bubble finally burst in 2021, breaking the illusion that property values would forever keep rising. China took harsh zero-COVID measures to try and control the COVID-19 outbreak. This affected the economy negatively. Shutting down factories and ports for long periods of time also affected business with foreign companies, global supply chains, and exports. The economy grew by only 3.9% in 2022. This was poor performance by China's standards. Real estate. The real estate industry occupies nearly 20% share in the Chinese economy. China invests roughly 20 to 30% of its GDP annually in its property and infrastructure sectors. Since regulations make it difficult to invest in stock market and similar assets in the country, many citizens invest their wealth in real estate instead. These are often pre-sold apartment projects, but now these buyers have no hope of seeing these projects getting completed. It is estimated that Chinese households have nearly 70% of their wealth invested in apartment projects. It is likely that the unfinished empty apartment units could be in the range of 50 to over 100 million in numbers. As prices continue to fall combined with slow sales, the developers and investors will not be able to repay the borrowed loans, leading to a wave of bankruptcies. Evergrande, a real estate giant, was recently ordered by a Hong Kong court to liquidate its assets after the company was unable to restructure $300 billion it owed to investors. As such a large developer collapses, it will adversely affect the property buyers, firms and suppliers doing business with Evergrande, and the banks and lenders. A crisis in this sector is then bound to spill over into the wider economy. As these lenders face a credit crunch, other businesses will find it difficult to borrow and grow in this scenario. After an 8-month-long investigation, now Chinese regulators have accused the company of inflating revenues by $78 billion. This makes it the largest ever financial fraud case in mainland China's securities markets. Deflation. Consumer prices dropped by 0.5% year-on-year last November. It is their fastest decline in 3 years. The property crisis has made consumers uncertain and wary of spending, further driving down prices. While falling prices may sound good when cost of living has become so high, what it does is that it leads people to hold out on new purchases, hoping prices will fall further, which then creates a vicious cycle that drags down economic growth. Debt. Chinese local governments are said to be saddled with $13 trillion of debt. China's debt to GDP ratio reached a record 288% in 2023. Stock market. Chinese stocks have lost almost $6 trillion since early 2021. Meanwhile, Asian markets have benefited as funds get pulled out of China and into other promising markets in Asia. Beijing has sought to put a floor under the share prices by pushing state-controlled funds to buy stocks and restricting short selling. But a recovery seems unlikely if investors lose conviction in the market. What is happening in China is reminiscent of Japan's crisis of 1989, when the Nikkei stock index fell almost 80% over the next 13 years and real estate prices fell for 2 decades, starting from 1991. Demographic crisis. China's fertility rate dropped to a record low of 1.09 in 2022, down from 1.3 in 2020. China has vowed to improve policies that support childbirth and to raise benefits for the growing elderly population. But it could be difficult to reap benefits of such policies when the young reproductive age population feels the future does not look so bright and that it's too difficult to sustain themselves, let alone have more children. Declining labor supply, along with increased healthcare and social care spending due to an aging population, will lead to a higher debt burden. Manufacturing sector. Post-pandemic China has seen many foreign manufacturing plants move to other countries such as India, Vietnam, Indonesia, Mexico, further leading to a decline in FDI last year. Economic instability, a trade war with the US, and rising labor costs are some of the reasons for this shift. In order to preserve and flourish this sector, China plans to lift foreign investment restrictions and formulate plans that strive towards technological self-sufficiency in big data, AI, and quantum computing. Geopolitics. The ongoing trade war with the US and supply chain disruptions due to the Red Sea crisis, which is the main shipping route between Asia and Europe, has further affected Chinese exports. As major economies such as the US, India, and Russia hold elections this year, a regime change in any of these economies could further affect trade relations. State censorship. On top of all these issues is the censoring of information by authorities. In December 2023, microblogging site Weibo, which is like the X of China, asked users not to badmouth the economy in their posts. The authorities tried to highlight only positive views on China's economic and market prospects, intimidating those that may portray a bad image of the economy. And what is the tool to strengthen this economic propaganda? Article 23, a 2020 legislation defining acts of treason, espionage, theft of state secrets, sedition, and foreign interference. If the state polity and its economy seem less transparent, it is bound to scare away foreign businesses and investors. In the end, most of the Chinese economy's problems today stem from the policies of the current government, starting with the 2019-20 decision to suddenly withdraw support for residential property development, to the harsh zero-COVID measures which kept the economy under lockdown for an extended period of time, and interference in foreign businesses based in China, as well as crackdowns on local tech firms. All of this led to erosion in confidence among investors and businesses, questioning sustainability in such an economic and political climate. China may not have fallen, but it has surely slowed down. There seem to be challenging times ahead, but there are also remarkable opportunities. China is at the forefront of AI development as well as a global leader in renewable energy. Taking advantage of its preparedness in emerging technologies, combined with structural reforms, it could bring back the confidence China seems to have lost.